The outlook for the global economy looks very bleak, with weak growth, high inflation, and an end to the era of free money. So how high will inflation get, and when will it start coming down? And also, when will growth start to improve? So that's the central case, but we'll also look at some accidents that could happen along the way that could make things worse. Now, if you do like our content, don't forget to subscribe to our channel. That way you won't miss any new videos. So let's look at the global economic outlook in a bit more detail. Let's start off by looking at the global economy according to the IMF. Now, this is the International Monetary Fund, which is the organization you go to if your economy hits the skids, as the UK did in the 1970s. But they produce this forecast for the global economy twice a year. And this is the report from October. And the pattern you can generally see is one of GDP deceleration. So the 6% you can see here for the global economy was the post-COVID bounce. Normally you'd expect to see something closer to around 4%. But in 2022, we get a deceleration to 3.2%, and then in 2023, 2.7%. And that's a slowdown in both advanced economies and also emerging market and developing economies. And if we break it down by region, you can see that generally the euro area is very badly affected. So is the United States, and also Latin America and the Caribbean. Other regions such as Sub-Saharan Africa, the Middle East and Central Asia, and emerging and developing Asia aren't so badly affected. But generally in those countries, we'd expect to see a higher level of growth because they're emerging, and generally they do tend to grow faster. Now, another way to forecast growth is to look at leading indicators, and these will be things like purchasing managers' indices. When PMIs are above 50, that signals expansion, and below 50 means contraction. And in the summer of 2021, everything was pretty good, the PMIs were generally high, but since then we've gradually seen them deteriorate, and some of them have already moved below 50. So the indicators are that we'll get weakening growth ahead. Similarly, if we look at consumer sentiment, that's also gradually eroded over the course of the year. And if we look at businesses, there again you can see sentiment has gradually got worse. And that's particularly true in the United States. Now, the job of a central bank is to maintain financial stability, but also to ensure that inflation doesn't get too high. And their primary tool is setting the interest rate. Now, during a global crisis, what you'll see is that all central banks will be cutting interest rates. That's what happened during the pandemic here. So easing policy means lowering interest rates, and almost all of the central banks were easing during the period of crisis. But now that we've had this inflation spike, what's happening is that both in developed markets and in emerging markets, monetary policy is being tightened all around the world, and interest rates are rising as a result. And this is a synchronized policy change. It's happening in a global fashion. Now, if you look back to 2008, what's interesting is that the downswing, the easing of policy, was synchronized in developed and emerging markets. But what we didn't have was an inflation spike that followed, and consequently there wasn't a simultaneous tightening into a period of weak growth, which is what we're seeing now. So really this is kind of uncharted territory to see how that will affect the global economy. But the general consensus is it's not good for growth. And the inflation spike is a global phenomenon. So here you can see the mean and median, and also the grey bars show you the kind of spread in inflation globally. And it usually bounces around 2 to 3%. Sometimes you have these little spikes, such as after the global financial crisis, there was a bit of an inflation spike. But what we're seeing now is absolutely huge based on the last 20 years' experience. So this is why central banks are being so aggressive with their interest rate hikes. The perception is that inflation would be much worse than a period of weak growth. And you can see how the IMF's forecasts have got gradually more glum as time's passed. So this is their January update. This is April, July, and now October. And it shows you the percentage of countries which they expect to be in contraction. That means 2 quarters of quarter-on-quarter falls in GDP. And in many countries, that's considered to be a recession. So almost a third of the world is now expected to be in contraction over this 22-23 period. And what we've also seen gradually over time is with each new forecast, the peak of the inflation spike has been revised higher. So the latest inflation forecast for developed markets suggests that inflation peaked at the beginning of 2022, and it's not really going to come down below 4% until the end of 2023. So the general pattern has been higher inflation peak and longer inflation duration. And if we look at emerging markets, the story is very similar, with the peak at the beginning of 2022 and a fall back to 6% by the end of 2023. So think of that as our central case, the most likely path forwards. What we'll look at now are the tail risks, the less likely outcomes which could have a large negative impact. Before we move on to talk about those tail risks, let me just quickly mention our weekly market roundup. It's absolutely free. It comes to your inbox on a Friday when I publish it. I try to keep it short and punchy, but it just cuts through the noise of all the irrelevant information and focuses on what's important for investors. So if you do want to do that, it's absolutely free. And to learn more about it, click on the link beside me and in the description beneath me. Now, each central bank will come up with its own financial stability report where it talks about these tail risks. And here are the Federal Reserve's worries right now. Now, each central bank always fights the previous war, and these 4 columns beside me are essentially the ones which went wrong during the global financial crisis. But I think 2 topics really stand out here. The first one is real estate valuations, and the second one is about structural vulnerabilities money market funds, which normally is not something you'd expect to see as a flashpoint for a crisis, but also some other mutual funds and stablecoins. So let's start off with the housing market. If you look at the growth of house prices over this period since the trough of the COVID pandemic, so that's between Q2 of 2021 and Q2 of 2022, the growth rate has simply been huge in US house prices. In fact, I've made a whole video about house prices. But that 17% growth is very unusual. The average in the United States is around 6%. And the size of the US residential real estate market is absolutely huge. It's about $53 trillion. So economically, this is a very important market, both for the US, but also in global terms. So here are those annual growth rates, and you can see just how unusual the growth rate we've seen recently has been. And this is based on 3 different measures: a Zillow house price index, one from CoreLogic, and also one from Case-Shiller. Now, we have seen some deceleration in that market, but it is just that, a deceleration rather than an outright fall. So a lot of that pain is yet to come. Now, the Federal Reserve's come up with a house price model, which tells you what the fair price of a house should be based on price to rent ratios, but also on the level of interest rates. And at the moment, you can see that in Q3 of 2022, house prices are egregiously too high. And the degree of that outpricing is about 25%. So there could be substantial falls if we go back to fair value, if this model's correct. But even if we look at straight price to rent ratios, you can see that the US is looking overvalued compared to history. In fact, it's looking pretty similar to where it was in 2007. How could the housing market destabilize the economy? Well, fortunately, this time around, banks have been more careful about lending, so there isn't such a big subprime problem. Also, banks are well capitalized now, so I think this isn't going to play out like it did in 2008. But there's always economic pain that comes with a house price fall. There's a wealth effect where people feel poorer, so they spend less, and that has a chilling effect on the economy, but also corporate earnings. The second market which the Fed highlights, which I think is interesting, is the total runnable money-like liabilities. That sounds a little bit odd. What does runnable mean? Well, you remember the run on the bank in Mary Poppins, where somebody asks for their money back and then everybody asks for their money back at the same time. And because banks don't actually have your money available to take out, that's called a run on the bank, and it can cause a bank to collapse. Now, it's not just banks which have runnable liabilities. The same's true of things like money market funds. These are super safe investments where if you put $1 in, you can take $1 out. You get a very small, safe return with these funds. And they're sold as being money-like, in other words, very stable. However, because you can take out your money anytime you like, the people that run the fund have to sell assets very quickly, so there can be a run on those assets if everybody's pulling their money out at the same time. And that can have a destabilizing effect. And what's interesting is that many stablecoins buy exactly the same assets as these money market funds. So there could be a cross-contamination route from stablecoins to money markets and vice versa. Also, the size of these liabilities is huge. It's around $19 trillion. Money markets alone in the United States account for about $4.5 trillion. And that's why this could destabilize the US economy. Now, as a share of US GDP, that's pretty huge. It's almost 80% of US GDP. And the biggest chunk of it is uninsured deposits. So if there is a run on, say, money market funds, it could cause destabilization. Because if the super safe assets suddenly start to fall in value, then that kind of takes away the underpinning of the entire financial system. So this is certainly a tail risk you should be aware of. There's also a kind of other category in the Financial Stability Report where the Federal Reserve asks a certain set of correspondents, what do you think are the tail risks for this year? And funnily enough, the one which worries people most is a Fed screw-up, in other words, monetary tightening. And if they get it wrong, persistent inflation. That's the biggest worry in people's minds right now. Second biggest is Russia's invasion of Ukraine, presumably if that spills out into a larger conflict. But also, of course, its effect on energy prices, which is affecting everyone. There's also market liquidity strains and volatility. That's the kind of crisis we just saw in the UK with the bond market and its effect on pension funds, where the Bank of England had to step in very quickly to sort out the problem. Higher energy prices are clearly on people's minds, as is China doing a Russia and invading Taiwan. So all of these tail risks could happen and they'd have a large impact if they did. It's just good to be aware of them, and that way you'll be mentally prepared if they do happen. Remember, all of these create opportunities to buy at lower prices. Now let's look at some of the tail risks as gauged by the European Central Bank. The most obvious problem is rising inflation and lower growth putting pressure on vulnerable borrowers. Now a lot of this is now central case, so inflation has spiked and the outlook has deteriorated. House prices definitely face a correction risk. I'd say that's central case as well. And rising input costs weigh on corporate margins. We're already seeing that happen for many companies. And the Ukraine war may challenge fiscal positions. So governments are having to spend to help their citizens get through this energy price spike, particularly in Europe. Markets are vulnerable as rates adjust to inflation and growth weakens. Yep, I'd say that's also central case. Higher for longer energy prices is a kind of given now. Although we have seen gas prices in Europe fall as we've had a very mild autumn. But the worry for the central bank in Europe is fragmentation risks. What happens if we have Italy leaving the EU, for example? That would be a huge tail risk. It's not clear that the EU could even continue to exist if such a large country decided to leave. And interest rate volatility increases, well, we've already seen that. Now, from the point of view of risks to banks, if we are entering a period of weak growth, then you'd expect default rates to increase, and then the loan book that these banks have may deteriorate, and they have lots of non-performing loans, which could create credit problems for the banks themselves. And of course, we've got problems with funding costs as interest rates increase, credit spreads widen, and we've seen that happen hugely in Europe. Then when it comes time to roll over debt, it becomes more expensive to do so, and companies could eventually go bankrupt if they can't service that debt. And then there are also risks to non-banks. So if you have big outflows from funds, this is the kind of runnable liability problems that the Fed was also highlighting. These rapid outflows mean that funds have to do a fire sale of their assets, which creates a kind of downward spiral. We saw that in the gilt market in the UK recently, for example. And of course, the usual suspect is illiquidity. So if you're forced to sell something which takes a long time to sell, you may not be able to sell quickly enough, and that could lead to the fund having to be gated. Now, just as in the US, there's been a huge surge in house prices in Europe, and that's left households very over-leveraged in some cases. So if you look at household debt to GDP ratios, but also the household debt service ratios, that's a proportion of your income as a household which you're using to service your debt. You can see that the countries where that's particularly worrisome are the Netherlands and Cyprus, which tick both of those boxes. High household debt to GDP, but also a high debt service ratio. Greece is another one that scores highly on the household debt service ratio, but also some countries you might not consider would be at risk, such as Luxembourg and Finland and Portugal. The ECB also has an interesting analysis of corporate sectors. So these are industries within the stock market, for example. And what they show is quite interesting, which is if you look at companies which are vulnerable, they tend to be clustered in countries which have elevated sovereign debt. So they've issued too much debt, which they may not be able to afford to pay, but also a weaker banking system. And the two countries which stand out here are Italy and Greece, but you can see Portugal and Finland also show up here. And the size of these bubbles are the non-performing loan ratio. In other words, how many of the loans have gone bad. Now, if we look at this sector plot, this is particularly interesting because it shows you the credit rating on the x-axis, with the lowest credit ratings on the right, highest on the left, and the direct and indirect energy use. Because remember, energy prices have spiked, and for some of these companies, that'll be a big increase in their costs. So airlines, road freight, air freight and logistics, railways, and interestingly, copper. These are the sectors that would be particularly negatively impacted. So if you do have exposure to those sectors, maybe it's time to get out. And once they trough, it might be time to get back in. Now let's look at the Bank of England. And their summary is that global economic conditions have worsened. So that puts pressure on the finances of households and businesses. The outlook is uncertain. Yeah, we kind of knew that. But they say that businesses can still access market funding. Now, this was published in July. Rates have gone up a lot since then, so the story might have changed. However, it's true, I think, that banks remain strong and well capitalized. The most worrying thing from the report, from my point of view, was small and medium enterprises. Now, these have a small proportion of the total corporate debt in the UK, less than 20%, but they employ half of the people in the UK. So if SMEs start to go bust, it's going to have a huge impact on UK employment. And a lot of these companies are working hand to mouth, so they have less than 7 days cash cover. So 31% of SMEs in February had insufficient cash to cover 7 days of their costs. Now, if you'd issued debt within a government loan scheme, that would actually have fairly favourable terms. But 70% of the outstanding stock of SME debt was issued outside these government loan schemes. And that'll be exposed to these huge bank rate increases, which we've had over the course of this year. Now, that won't have an immediate effect. The bank estimates it'll take a year to feed into the costs of those companies, but we could see a big pickup in SME defaults over the course of this year. And if we look at interest coverage ratios, those are also at elevated levels. So the debt servicing costs are certainly going to be an issue over the course of this year and next. In conclusion then, we see clear signs of scarring in the global economy. In other words, long-term negative impacts of COVID, but also the consequences of COVID, which is the inflation spike, combined with high energy prices due to Russia's invasion of Ukraine. So we're going to have to deal with that legacy for some time to come in the form of lower growth. And these problems are going to be exacerbated by the fact that we've got simultaneous tightening of monetary policy, in other words, raising interest rates by central banks all across the world in developed and emerging markets. And that'll also come with a period of greater austerity, in other words, less fiscal spending by governments. All of this will probably make growth even weaker. Now, in this kind of environment, even though the central case is looking bleak, it's also more accident prone. So there could be pockets of leverage out there where increasing interest rates will flush out these problems. So, for example, there could be large corporate defaults, which have a huge negative impact on sentiment and also on risky asset prices. But before you start to think it's all doom and gloom, remember that it will get better. Over the long term, this creates opportunities, and that this should actually create more buying opportunities rather than just getting glum about the outlook forever. So the economic outlook looks pretty grim, and we are conducting this huge monetary policy experiment where everybody is tightening at the same time, combined with austerity in some countries. So I think that'll probably make the problem worse. But remember that this does create opportunities. So look out at those valuation measures and just see where we stand and make use of those opportunities as they arise. Now, don't forget our offer. If you want to learn about markets and keep up to date with what's going on with relevant stories, sign up for our free weekly market roundup. There'll be a link beside me and in the description beneath me so you can learn more about that. And as always, thank you for listening.